Portfolio diversification in apartment investing. Portfolio diversification is a cornerstone of sound investment strategy, particularly in apartment investing. By spreading investments across various asset types, locations, and property classes, investors can reduce exposure to specific risks while enhancing overall returns. A diversified portfolio not only mitigates volatility, but also improves long-term resilience and risk-adjusted performance, allowing investors to achieve a stable and sustainable growth trajectory. Key concepts in portfolio diversification for apartment investing. Understanding portfolio diversification. Definition. Portfolio diversification involves allocating investments across different asset classes, property types, and geographic locations to minimize risk concentration. Benefits. Risk reduction. Diversification reduces dependency on the performance of a single asset or market. Volatility. Mitigation. Spreading investments balances gains and losses across the portfolio, smoothing out returns. Improved risk-adjusted returns. Diversified portfolios often achieve higher returns for a given level of risk compared to concentrated portfolios. Portfolio resilience. A mix of investments creates a safety net against economic downturns, market-specific challenges, or tenant-related risks. Example. A portfolio combining stocks, bonds, multifamily properties, and industrial real estate experiences less volatility than a portfolio solely reliant on one sector. Why diversification is essential in apartment investing. Market-specific risks. Localized economic changes such as layoffs in a city's primary industry can affect rental demand. Asset-specific risks. Issues with a single property, such as unexpected maintenance costs or regulatory changes, can significantly impact returns if the portfolio is concentrated. Leverage risks. Diversified financing structures across properties protect against risks tied to a specific lender or interest rate environment.